Hi guys, Louie here, and welcome to the weekend. Today I'm going to take a stab at doing a relationships video, a deeper dive, if you will, into gold, silver, and what drives the prices, in addition to manipulation, which I think also drives the prices. But I think it would be good for people to understand that it's not just about the dollar, right? There are so many stories out there about the demise of the dollar and the rise of the BRICS. And it could lead you to believe that there's only one thing that potentially will move silver and gold. And in reality, there are at least, a half a dozen to a dozen different drivers to the price of silver and gold. So I'm doing this to help deepen understanding of the various things that impact the prices, mostly so you won't be tempted to run out and act with, let's say, all your money at one time because you saw a video about the BRICS impending gold-based currency announcement, that's going to happen in 8.5 hours, right? Don't you wish you had a nickel for every time you saw a heading on a video that said, this will happen in 45 days. This will happen at the end of the month. That will happen on July 29th. This will happen in 18 hours. Okay, any video you see like that, take with a grain of salt. They're really, they're pushing one particular narrative, a narrative which I tend to agree with, which is what makes it so powerful. But it could be a long-term narrative, and you could potentially be buying at the wrong time if you're looking to get the best price. For me, having been doing this for a while, I want the best spot price and I want the lowest premiums, and both of those seem to be coming down lately, and that's why I want to give you a little better understanding of this. I will also say that becoming a stacker has given me a far greater comprehension of economics. Not as good as some of you guys, and I know there are experts out there that that know far more than I do. But if you understand the 6 to 12 drivers that drive the price of silver, you might be a little better at predicting where we're headed. Now, let me stop here for 1 second and say thank you to everybody who has shown up, the new subscribers, and the people I have not met yet. If you would, at this point, go ahead and tickle that like button as a reward. Here's a picture of Ariana Grande. Okay, let's get going. Here we have silver. This is a Queen's Beast. I believe that's a dragon, collectible 2-ounce coin. This is a 1/10 gold piece, I think from Golden State Mint. Just a little 1/10 gold worth $200 or maybe a little less. It is not an Indian. It's an Indian replica. I don't want to mess with my settings here. All right, so let's start by talking about the relationship of silver to the dollar. I'm going to leave gold out for a second. So it is generally true that silver is primarily a commodity and secondarily an investment metal. All right, when the dollar goes down, silver tends to go up because silver is priced in dollars as a commodity. That relationship generally holds true for most commodities, right? So a drop in the dollar is usually good for silver, not always, but usually. If the dollar goes up, then usually price of silver will drop because commodities have become more expensive. All right, so that is a relationship that tends to hold over time. Silver is also an investment metal. You could call it a currency if you'd like to. I like to call it a currency because our founders called it a currency, right? So the investment demand is more linked to gold than it is to the dollar. But let's just say that investment demand, the marginal demand, is driven by investors. And investors are sometimes excited when prices are going up and they jump on the momentum. and investors get unexcited when prices are going down because, the trend is down and they think they'll get it for cheaper. All right, let's stop for a second and talk about gold. Now, gold and silver have a relationship not from the commodity angle, but from the investor angle. All right, now let's look at what moves gold. This is fairly standard in the industry. Gold tends to move up when the dollar moves down, but not always. All right, gold also moves as a relation in relation to the 10-year yield. All right, the 10-year yield goes up. It's about 4% currently, has been moving up a little bit, and that tends to depress the price of gold. This is what happened, I think, on Thursday. We had the FOMC raise rates, threaten to keep raising rates, or at least stay higher for longer. Not on the day of the release, but the next day, the 10-year yield went up in relation to that Fed announcement. What happened to gold? It dropped. All right. So that tends to hold true. The other thing that tends to hold true is the 10-year yield is related to the dollar. Okay. So the 10-year yield going up makes our dollar a better investment for everybody, including foreigners, and it tends to drive up the price of the dollar when yields go up because you're making more money on the dollars you purchase. If the 10-year yield goes down, let's say we start to enter recession, the Fed lightens up a little bit, maybe starts to dip, that will depress the price of the dollar. What happens when the dollar goes down is often gold, wherever the heck I put it, where'd it go? Gold will tend to move up. So we have the 10-year yield and the dollar often moving in lockstep. And when they're going down, when the economy is declining, gold tends to go up because rates have gone up. The carrying cost of gold is lower. It has no return, no dividend, no interest, unless you're invested in miners or somehow you pledge or option your gold. Don't do that. So that tends to move gold up. Also, when gold moves up, silver tends to follow by relation of the GSR, the gold-silver ratio. It has been as low as 16, and it has been as high as 110, 112, something like that. Currently, it's about 80. I think it has upside to maybe 84, which would mean silver could drop a little bit in relation to gold. And it has downside, definitely down to 60, I would say. You could argue it could get to 30, or you could argue it could get to the natural relationship in the earth of 7-1, I think, which would put silver in relation to gold. That does not mean that gold and silver have to go up in price or down in price. Gold could drop to $1,000 and silver could could stay right where it is at 24 and change. And the ratio can increase even when prices are dropping or when prices are rising, which is an aside. I probably didn't need to go down that tangent. Okay, so we know that investor demand drives, on the margin, drives silver price. We know that the 10-year and the dollar also drive prices. All right, and I have alluded a minute ago that the 10-year yield and the dollar tend to go up and down in unison, but sometimes they don't. So when does the dollar move in its own relationship? Okay, here I've got a German mark from the Olympics. I don't know if I can read that. 1972 Olympics. I don't know. I think that might be a 0.8 silver content. I got a tube of those from Gainesville Coins once. So the dollar has another mechanism, and this I'll get to the brick story in a minute. So when foreign currencies are rising, sometimes the dollar will fall. All right. The dollar is based on a basket of currencies, primarily the euro. There are no Deutschmarks anymore, but there is a euro. And as the euro strengthens, the dollar falls. And as the euro declines, the dollar rises. And it also has to do with Japan and the UK and China, I think. Yeah, I think China's in the basket. So that can happen independent of the 10-year yield. All right, if you're starting to get the complexity of these relationships, you'll understand that a rising euro may mean a falling dollar, but then again, rising rates may mean a higher dollar, right? So there's multiple things going on. Now, to the story of the BRICS, I have no doubt that they're messing around with a basket of gold, and maybe they will announce something, but I think that is a story for the next 10 years, the next generation, possibly. I do not think that the BRICS move will have a large effect on gold. I think it is around the edges. To the extent people get excited about it, it could push gold up, but it's not likely anytime soon that the euro and other foreign currencies are going to supplant the dollar. It's a slow-moving thing over time, yes. But what else has to happen for the euro and other foreign currencies to do better than the dollar? Well, tying it to gold would be good, but how are they tying it? Is it redeemable in gold, or is it based on the promises of some banana republic that is going to be lying about the actual backing of gold? Is it backing of gold of 100%? Is it backing to gold of 50%? Is it backing to gold of 1%? All these things matter. And foreign governments have proven they are not as trustworthy as the U.S. government. And I know that we have lots of reasons to be displeased with the U.S. government, many, many reasons, and I am as well. That's why I stack. But if you think that foreign governments are going to be more fiscally responsible than the U.S. government, then we would disagree on that. Now, you may find some examples where foreign governments have not raised their debt level to 33 trillion, and perhaps as a percent of GDP, they are more responsible at the moment. The wheels are going to fall off the bus on the world and in Europe. All right, they're going to go into recession. They're going to go into recession, and when they do so, they're going to start lowering rates and printing money, and I think the dollar will remain strong in the face of that. I think that in the U.S., I think we're going to get a change in politics, and we may have more constrained fiscal policy. Right now, a lot of the movement in the stock market is related to GDP. Okay, the other thing that can move the dollar and inflation. I'll get to that in a minute. So the GDP printed, it was quite strong, and it was comprised entirely of two things: government spending on Biden's boondoggle Inflation Reduction Act, which is throwing money to unions all around the country to build stuff, as well as bailing out the Teamster Union, which nobody ever talks about. So Biden money, Bidenomics, is raising GDP artificially. It's the government spending. If you look, and also the auto industry, which is recouping from supply chain problems, and we had a one-time bump in GDP and in the auto industry revenue, both from prices and from the reversal of the supply chain issues. GDP is unnaturally going up right now, and that's partly what is driving gold down. When GDP goes up, people start to worry about inflation. Inflation is there, it's real, but it's been dropping. However, there has been, because of rising GDP from the government spending perspective, and because the Fed, or just because the economy appears to be strong, on the surface, underneath it is not, that gives people fear of inflation. That raises that depresses that, and that has a GSR relationship on this. There is also a wild card in all this: war. Now, when war happens, okay, let's start over. When war happens, it's very simple. People get nervous, they buy gold. All right, that's the last time that we saw a spike to all-time highs in gold, was when there was lots of fear over the Ukraine war. And when gold goes up, it often brings up silver, especially if we're not predicting recession. So watch out for that. So I hope I have added something to your basket of knowledge that will help you to predict to some extent what might be happening next. For example, if we're going into an FOMC meeting and you think that GDP may print strong, then you may also think that rates are headed up, and then that may cause you to wait, as I did. It was the day after where silver and gold plummeted, right? And now that interest rate move is reversing somewhat, the dollar is reversing somewhat, and we've come back up a little bit. But this is in the environment we're in. So going forward, inflation is here, but I don't have anything to represent oil, but it has been dropping, and I think in the long term it will continue to drop. Temporarily, however, oil prices going up are a big driver of inflation. So it's likely inflation will tick up in the short term. It is also probably likely that interest rates will tick up in the short term. It's also likely that as a result, the dollar will tick up, and it is also possible that metals may show some weakness, especially over the summer when very few people are buying. So that is the short-term relationship. In the long term, I think GDP will crash. I think we'll go into recession. I think as a result of recession, I think inflation will drop. Okay, not that it won't come back when the Fed starts printing, but the Fed will not be printing, until we get the recession. All right, and then in that recession, we will see the 10-year drop, and we will probably see gold prices go up. Silver prices may or may not go up. Okay, so if the fiscal situation is really dire, very possible gold could shoot up. The GSR will come into play, and the monetary side of silver may push up, right? And the more it pushes up, the more the momentum pushes up, the more the buyers come back in, the more spot premiums start to increase, and then we get demand on the investment side for silver. However, if the recession is severe and interest rates go back to 2%, silver could react in an opposite direction, and you could say that there is no demand for silver. People are not making solar panels and electric vehicles and everything they put it in these days, and therefore the demand on the industrial side, the primary side of the silver demand, could drop. Or it could stay in the middle because, monetary is pulling it up and recession is pulling it down. If gold runs, it'll drag silver no matter what, because momentum will come back, and then all the hedge funds will start buying. And we will all, simplistically say something like the dollar is crashing, right? But it isn't that easy. I'd encourage you also to watch the Dollar Milkshake guy. He's got a channel, and he explains why the dollar is not down and out. All right, because it is related to a basket of junk out there. The world will crash far worse than the U.S. will crash, and the Federal Reserve is the dominant driver of many things. So don't think the dollar is necessarily out. Don't think that Europe is necessarily strong. Europe is exploding, right, due to energy policy and loose monetary policy. Just because they raise, interest rates a quarter of a point hardly anything to write home about. So don't count the dollar out, and do count your metals in. But if you like to follow that stuff, then follow that stuff. It is extremely interesting. Sometimes we get it right, sometimes we get it wrong, and none of these relationships are ever 100%. If they were 100%, we'd all be rich, right? Because smart people know all of this. But nothing is 100%. Nothing ever is 100%. You can have the dollar going down, and you can have the dollar going up due to weakness abroad, and you can have gold going up. You might even have silver going up. So that happens sometimes, especially in recession. So there you have it. I hope you found this interesting, and you guys, let me know your comments. I'm sure I made a couple of mistakes in here, but I really did not study any of this until I started stacking, and it really is interesting to watch the drivers of the economy as they drive real money, because that is real, the stuff that's in. Now, a lot of it is fake. A lot of the CPI is fake. The GDP is fake, to some extent. The amount of debt outstanding, 33 trillion, is fake. We know there's lots more debt than that. Let me talk about manipulation real quickly about silver. I think silver is more manipulated than gold, personally. So how does manipulation, sorry to make this video over 20 minutes, but I forgot to include that. What I think happens, and this is tinfoil hat time, but with the millions of ounces in the paper market, they can push it up. By just buying more silver. They can push it down by writing put options, or selling calls, or whatever they do. They've got millions of ounces. They've got, dozens of times the annual production of silver trading in the derivatives market. It is clear they have the power to do anything they want. Getting caught, well, that's another matter, and they have been caught before. But here's what I think happens. I think when these natural things occur, when there are headlines that hit the market, they look for opportunity to manipulate. So if they think let's go back 2 weeks ago. If they think 2 weeks ago that that in the future the FOMC is going to rise, they could be buying ahead of time paper purchases, right? Not necessarily for the purpose of redemption. I think that is a side story, on the comics, etc. That push it up, from whatever, 22 to 25. We've got a 2-week period to do so. They build up, that position on the upside. And then before the FOMC meeting, day before, day of, day after, they write their put options. Dollar has gone up. Silver is about to experience both an interest rate rise and a dollar rise. And they have got their excuse. They've got their cover to, where'd my silver go? They've got their cover to crash it. They cover their puts, or they cover their shorts. Silver crashes $2. They cover their shorts, and then it goes back up to 23 or 24. They have made millions of dollars by manipulating the range, right? And every time they do that, another silver stacker says, oh, God. They also discourage investment through manipulation. They enrich themselves using the news, and then, they discourage investment. And if they can get a scenario where there is a so-called silver squeeze, pushing silver up, getting everybody euphoric, pushing the momentum up, getting up to $30, and then they do some tricks with, margin requirements and whatnot, and they find, they pick a point where the 10-year starts to go up, they pick a point where the dollar starts to strengthen, and they can short the hell out of that all the way down to $20. They have made a fortune. Silver squeezes enrich the manipulators. It also enriches the retailers who raise their premiums, and it also discourages stacking because these guys that bought $45 Eagles now can only get $28 for them, right? Check, sorry for the blurriness. Check Vermilion Enterprises. He is selling Eagles for $450 over spot. Solid date tubes, $450 over spot plus $13 shipping. Okay, Monument Metals had Eagles for under $30 any quantity pricing, and people think that the premiums are going to go lower. They don't think that when we're entering a strong period. They think that when we're entering a weaker period because they got to dump the silver they bought at a higher price. And so those premiums have depressed. Junk is falling rapidly. So anybody who said buy junk at any price was not carefully considering what can happen in the cycles. And so this is, again, how the manipulators, in my humble opinion, and, just tinfoil hat time, they make money, they discourage stacking, they make the government happy because it makes the dollar look stronger. And the only person that suffers is the stacker. The only stacker that wins in the long term is the long-term stacker. You don't get excited by FOMO. You don't give up when prices fall. You actually do the opposite. And you do that over 10 years, and in time, your $10,000 stack will be worth $20,000. And if you sell it when there's a FOMO event, which we all should have been doing a few months ago, you might have $30,000. This is how it works. All right, I would love to hear your comments. Isn't that a cute little pistol? Like I said, probably got something wrong, probably oversimplified. Did I pour this? No, that's a Monarch little pistol. Those are cool. You can always buy. You find something like this for $5 over spot, you can buy a boatload of them because people always want something like that. All right, so please give me that, tickle that like button, subscribe if you would like to, and we will have more in-depth information about silver and gold for thinking people. All right, that's what I'm all about. You guys take care. Have a wonderful weekend. Bye now.